Hi, I'm Jason and welcome to First Super's end of financial year investment update. I'm joined with First Super CEO Bill Watson and we'll be reflecting on how the fund performed for members during the 2023 financial year. So Bill, we delivered strong returns for our members this year. Can you tell us a little bit more?
Thanks, Jason. We saw positive results for all of our investment options last year. Our return was 9.44% for the super balanced option and 10.14% for our pension members. Both our super and pension balanced options outperformed several larger funds this year, which was rather pleasing.
Fantastic result for members. And can you tell us a little bit more about our performance over the longer term?
Yes, Jason. And of course, it isn't just about 1 year, it's about how we string performances together each year over a longer period of time. So our accumulation balanced option is in the top 10 for the average 3-year returns according to Super Ratings. Our balanced option has secured positive results for members in 9 out of the last 10 years, with the exception of the COVID pandemic year of 2020. What that means is for a 10-year period, our balanced option average returns are 7.83% for accumulation members. We're pleased to provide consistently robust results for our members because Super's about the long term and we've delivered that.
Fantastic. And Bill, a trend during this financial year was continuing volatility. Can you tell us how First Super manage members' investments to overcome this?
Yeah. So constantly monitoring how our investments and our managers going is absolutely key to this, and also having a sound investment strategy. At the start of the financial year, there were concerns about a global recession, but these have eased as inflation's moderated, and we think that we can see the end of interest rate rises coming into sight. So this contributed to good returns in Australian and international equities. Share markets responded positively to positive news. But international bonds had another poor year because of interest rate rises, where Australian bonds were positive. Globally, property performed poorly, and that's a lot driven by COVID return to work, while Australian listed property was positive, but unlisted property was negative, and the difference there being share market sentiments versus wholesale investors. For us, private equity, property, fixed interest and floating rate debt contributed positively to our results. Our investment managers deliver good returns in Australian equities and international infrastructure, so they outperformed their benchmarks. But we also invested less money in property and international fixed interest, both of which underperformed. So what it meant is we had less, so we lost less in those asset classes. Volatility is just normal in investment markets. And as I've said about our 10-year returns, it's over the long term that we really focus on. What we do is diversify investments amongst asset classes so that we've got an opportunity to offset losses in some areas with the gains in others. And that's what we've done in the balanced option diversification. So we've spread the risk of underperformance by investing in a range of classes.
So shifting the focus into 2024 and what's on the horizon for investors, what does this sort of look like for our super?
Markets are becoming less worried about inflation as it's slowing, but we're still seeing emerging concerns in the United States about the persistence of inflation. So what that could potentially mean is further interest rate rises in the United States, so that then gives a very strong US dollar, which has a negative impact both on Australia and our major trading partner, China. However, the higher interest rate rises could see growth in both cash and the corporate credit asset classes. If interest rates fall on an official basis, government bonds could also generate positive returns. We'll continue to see property asset classes stressed worldwide, with particular focus on the United States, with a number of distressed sales because of very high leverage, and also just a decline in demand for office space across the United States. Equity markets mightn't grow as much this financial year, but they've started off positively. What would be interesting in equity markets is whether we'll see some growth from a number of companies that really haven't benefited from the growth in share prices over the last couple of years. It's really been concentrated on the tech sector. So if the tech sector falls away, that could possibly be negative. But if we've got other stocks that start to pick up, then that could be positive. So it's a bit of a mixed bag there. And then finally, we've got the unknown unknowns, which is the ongoing uncertainty around the Russia-Ukraine war. Things are getting desperate for the Russian government, there is a risk that they will take actions that nobody's forecast. One of those could potentially be constraining supply of petroleum into Western markets, which would have a significant inflationary effect as we saw in 2020. So we just don't know, and that's a risk. So the job that our investment committee and board's got is continuing to actively review our investment strategy and manager performance to make sure that we continue to be positioned to manage the downside risk. What we don't want to do is lose members' money because it's harder to recover.
And finally, Bill, what would you say to members who have further questions about their investments?
We're here to help. We've got a team of people who would love to talk to you. So we've got staff in our contact centre, and unlike a lot of other funds, you can ring up our contact centre and get through in less than 3 minutes. So you're not going to stay on hold forever. We've got member and employer service coordinators who are out in the field that can do old-fashioned face-to-face visits. They're here to help. And then finally, we've got our financial planning team. Their job is to give you the best advice that suits your personal circumstances. And they're employed by the fund. So they're committed to delivering great advice and really quick advice to members of the fund and their families. And you've got to remember that with the exception of personal advice, there's no extra charge for a member to discuss investments with an expert. So pick up the phone. My objective for this financial year is to make sure our financial planning team is yet again exhausted by the 30th of June because they've provided a ton of good advice.
Fantastic. Thanks for joining us, Bill. Thanks for tuning in, and I hope to see you again next time.